Welcome to The Tax Factor, the top 20 business and investment podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with Heather Self and Martin Reynard.
Welcome to The Tax Factor. I'm Heather Self. After the celebrations for our 50th podcast, and then Matt and Ellie last week celebrating our 51st podcast, we couldn't find a reason to celebrate the 52nd episode. And then I remembered, our guest this week is Martin Reynard, a pension expert at Blick Rothenberg, making a welcome return to the podcast. Welcome, Martin.
Thank you, Heather. It's nice to be back.
Let's start with pensions, shall we? We've talked quite a bit about what Rachel Reeves might have in her budget on 30th of October, but we haven't mentioned pensions, and there's lots of rumours that we might get some changes there. Just remind us what the basic system is at the moment, Martin.
Yes, for sure. Tax reliefs come in several forms on pensions. Perhaps the main one, and certainly the one up front, so to speak, is that you will qualify for tax relief or income tax relief on pension contributions when they are paid in at your full marginal rate of income tax. So that can be income tax relief at 20%, 40%, 45%, 60% even if your income would otherwise fall between 100 and about £125,000. In addition to that, the pension funds that you will invest in tend to grow free of tax. The investments, there's no income tax on income received by the investments. There's no capital gains tax to be paid when pension schemes sell investments. Come retirement, whilst primarily the payment in retirement is a pension income, which is itself subject to income tax, there is nevertheless a highly popular tax-free element, which is about 25% of your pension fund in many cases. And finally, if you happen to die without fully exhausting your pension fund, then pension funds are not normally a target for inheritance tax. Although income tax might be paid by your beneficiaries on the pension funds they eventually draw down of yours if you happen to have died at or after age 75. But on death before age 75, generally speaking, pension funds will pass on without a tax charge.
So very briefly, full tax relief on the way in, tax-free growth, taxed on the way out, but up to 25% available as a tax-free lump sum, plus the potential inheritance tax benefits. What do you think are the most likely things that might change in the budget?
Most popular opinion seems to be that an obvious target is the tax relief given when contributions are paid. And certainly that would, as it were, offer immediate savings to the Treasury if the amount of tax relief given on contributions is reduced from the individual's marginal rate of income tax, perhaps introducing a flat rate. Indeed, if the rate of tax relief is set at 20%, the basic rate for everybody, that has probably the potential to save in the order of £15 billion a year in tax relief given by the Treasury.
That's quite a chunky sum, Martin, and will go a long way towards filling the 22 billion tax hole that Rachel Reeves keeps talking about. But wouldn't it be quite complicated, particularly for people in the public sector who've still got defined benefit pension schemes?
Oh, yes. The defined benefit pension schemes, which approximately half of individuals, if you like, would be a challenge. It's even with defined contributions, it's not particularly straightforward, but I can see it is manageable by using the PAYE and payroll systems to perhaps, if any, in effect, any tax is due or reduced tax relief is due on defined contributions, then that can be accounted for when contributions are paid, in effect reducing the amount that reaches the pension fund to begin with. But that's very difficult with defined benefit because by definition, you're trying to fund a particular benefit and you need to put a certain amount in to look to achieve that goal. You're wrong-footed if those contributions are themselves reduced because of a tax deduction. The alternative of charging public sector workers extra tax based on the full pension contribution would obviously be a challenge.
I think challenge is probably understating it, but for those with personal pensions, I can sort of see how they might do it. I think a long time ago when you did personal pension contributions, you paid them net of basic rate tax and the pension scheme claimed back the basic rate and then you claimed the additional rate on your tax return. And that seems to me a way that it could be done, that if you were going to limit relief to 20%, then you just say, right, all your contributions, you do them in cash, the pension scheme claims back 20% and off we go. But for defined benefit ones, much more difficult.
Exactly.
Rachel Reeves has spoken in favour of this, though, in the past, so it might be something she's looking at. If it did happen, would it be from budget day or would it be not until next 5th of April?
I think in terms of actual implementation, and if, as is generally accepted, this is as much a payroll function as anything else, then you have to give payroll providers the time to bring in those changes. And, the start of the next tax year is obviously might give you enough period in which to do that. That doesn't prevent, of course, with a little bit of clever thinking, some form of anti-forestalling measures, but that would surely add to complication.
Yes, otherwise you can see everybody will be rushing to top up their pensions like mad in the period before the end of the tax year.
Yes.
Let's turn to the other thing that's been mentioned quite a lot in the press, and I think there was a report by the Institute for Fiscal Studies recently which looked in detail at some of the potential options, and that's the tax-free lump sum, and that's roughly 250,000. It was limited when we had a lifetime allowance limit. The lifetime allowance limit is gone, but there is still a limit on your tax-free lump sum. But 250,000 is quite a lot to get tax-free.
It is. It would come hand in hand with you having to have a pension fund of over £1 million because you're also limited to a tax-free sum of 25% of the total value of your pension funds. So it would impact. It is thought that a reduction, you mentioned the IFS report, and they suggested reducing the tax-free cash lump sum allowance to just £100,000, quite a reduction, but their assessment is that would impact about 20% of retirees given current pension fund values, or to put it another way, 80% of prospective pension retirees have pension funds of less than £400,000 and would not be impacted by the introduction of a £100,000 limit.
And did the IFS put a figure on how much that might raise if you limited the tax-free lump sum to 100,000?
They did. They suggested, measured over the long term, so I'm not exactly sure what that means, but they suggested it would save £2 billion by reducing the tax-free allowance to 100,000, as opposed to the 5.5 billion that it would cost to keep matters as they are.
I think, in my view, that's the thing which would be an easier target for the government, and they could do that from budget day. So while we would never advise anyone to do anything specifically for tax reasons, if you're coming up to pension age, so this is only those who are over 55 at the moment, and you're thinking of taking your lump sum, perhaps worth talking to your financial advisor before budget day to get things in motion and perhaps benefit from the higher allowances at the moment.
I think that's true, but all we know for sure is what the rules are today and how it would work if you acted today. We don't know what those rules will be in 6 weeks' time.
Thanks very much for that, Martin.
You're very welcome.
Turning to a different topic altogether, Matt Crawford last week commented on the tax case relating to Stuart Barnes and whether he was employed or self-employed. That was an upper tribunal case. I'm going to trump him with a Supreme Court case relating to the Professional Game Match Officials Limited. So we're moving from rugby to football, and this is about referees in football matches, not the ones who are full-time and clearly salaried people, but what's called the national group, who are highly qualified referees who can take on the higher level matches, but they do it on a week-by-week basis. They're licensed by the Football Association, and every Monday they're asked, do you want to take on this match on Saturday, yes or no? If they accept the match, then they referee it in accordance with the Football Association rules. Now, you might think that doesn't sound very much like an employment. However, it's gone all the way up to the Supreme Court, and they've held that there is enough evidence of two of the key factors. Firstly, that there's sufficient mutuality of obligations, i.e. an expectation of offering and accepting work, not on an annual basis, but on each individual game. That slightly surprises me because it's only offered on the Monday and you referee the game on the Saturday. That seems quite a short period. And secondly, that there's sufficient element of control. So that's two of the three key factors. But as Matt said last week, you also have to look at the contract overall and look at all the facts to decide decide whether or not it looks more like a contract of employment or a self-employed contract for services. Having gone all the way up to the Supreme Court, this is therefore going to go back to the first-tier tribunal for them to make a decision on the facts, taking into account the guidance that's been given by the Supreme Court. Now, this is about individuals, but it will also be relevant if you are a company that's engaging people through personal service companies, because companies other than small companies do now have to consider whether the people working for them are employed or self-employed. So there's lots of good guidance in this case. However, it just shows how difficult it is. I think nearly every week on the Tax Factor, we've commented on various cases on employed or self-employed. It's a mess. I'm not sure there's much Rachel Reeves could do about that in the budget, but it would be good to see her try. Getting towards the end of our podcast, Martin, I think we've got a brief mention of a birthday to come out.
We have indeed. 1994, 30 years ago, saw the launch of the Enterprise Investment Scheme.
And that's good news for individuals and companies potentially?
I suppose it seems to work very well for three main stakeholders. One is private individuals as investors. The second is the smaller early stage businesses who are looking to raise capital they might not otherwise have access to. And it has to be said, the government stroke HMRC, who seem to be very happy with how it's running, as they've not seen fit to tinker too much with the rules or perceive that there's any abuse or anti-avoidance in how these schemes are operating.
So that's a happy birthday to the EIS scheme, and let's hope that that one doesn't get tinkered with in the budget. And finally, I thought I'd just mention the tax implications if somebody offers to buy you a suit. If it's a pure gift from a friend, that's fine. Gifts are not taxable. But if it's from your employer and it's not in the form of a uniform, so a policeman's uniform is fine, but a suit for Martin to go to work at Blick Rothenberg would not be. If it's from your employer or if it's somebody by reason of your employment, then that'll be a taxable benefit. And if you're self-employed and you want to buy your own suits, I'm sorry to say that that won't be wholly and exclusively for business purposes, so you won't get a tax deduction. And that follows the case of a barrister called Anne Mallew, now Baroness Mallew, who claimed that she only bought black clothes to wear in court and wouldn't possibly wear them any other time because they were hideous. However, the tribunal held that she had a subconscious motive of warmth and decency, so she couldn't have a tax deduction. So there you go.
The Tax Factor.
That's all we have time for this week. We release the podcast every Friday on the Blick Rothenberg website and on all the usual podcast platforms, so you can listen wherever is most convenient. We record and release the podcast in less than 24 hours, so you always get the very latest news and updates. If you enjoyed it, please subscribe and give us a rating or review.
Next week, Rob Goodley is presenting the podcast, and he's joined by a new contributor to the Tax Factor, our head of private client at Blick Rothenberg, John Bull.
But from us, it's goodbye and have a good weekend.
Goodbye.
That's the Tax Factor. We'd like to thank you for making us one of the UK's top 20 podcasts. Find all our previous episodes wherever you get your podcasts. And join us again next time on the Tax Factor.